You are betting against the trend. The same can be argued for a double bottom. You are buying a market that is moving down. 30 years of data. I am a day trader. My specialty is stock indices such as the Dow Jones Index. I looked at the statistics of closing prices in the index over the last 30 years. That equates to roughly 7,500 trading days. I wanted to know how often the Dow Index closed higher for the day and how often it closed lower for the day compared to the previous day's closing price. I had an idea that, since the Dow Index over the last 30 years had risen from 3,300 to nearly 36,000, you could expect more positive closing prices than negative closing prices. I was wrong in that assumption. Over the last 30 years, only 50.4% of all closing prices were higher than the previous day's closing price. This means the distribution of plus days and minus days in the Dow Index is evenly distributed. The ramifications of this statistic is that day traders like me can't rely too much on the trend on the higher time frame, because virtually anything can happen down on the 5-minute chart. The challenge traders face can be summed up very easily in a Heraclitus-style explanation. When we shop for a pint of milk, we know that milk is a uniform product. It doesn't matter where on God's green earth you shop for a pint of milk. Milk is milk. Hence, if milk costs twice as much in one supermarket as opposed to another supermarket, you can again rightly conclude that a pint of milk is expensive in one supermarket and it is cheap in the other supermarket. However, a share or a currency or a share index is like a river. It is in constant transformation. The transformation is the result of the interaction of traders and investors. Their action is the result of their opinions about the future. You may agree with their opinions, or you may disagree. But to say that the majority are wrong is counterproductive to efficient money-making in the markets. There are many part-time traders who are incredibly successful in their other careers, but struggle when it comes to trading. What we have to do to succeed in the world of trading is significantly different to what we have to do to succeed in the world outside of it. For example, if you go into a supermarket to buy dinner and you see that there is a special offer on chicken, you will be inclined to take advantage of this offer. If chicken is offered at half price, then you might be thinking that this is a great price, and you will want to buy some supply for the freezer. Our human nature is such that we love a bargain. We love to seek out good offers and take advantage of them. It fills us with a sense of joy to know we have bought something which is cheap. Just yesterday I went shopping and there was an aisle with discounted items. Everything was half price or less. I bought soap and washing liquid and detergent for the next 12 months. As I filled the trolley, I laughed to myself, mostly because I knew that I would go on to write a chapter about this very behavior. It felt great to save 70% on stuff I knew I would buy anyway at some point during the year. Let's face it, we can save a lot of money if we shop contrary to the trend. If at all possible, I tend to buy my winter jackets when there is a heat wave outside. That is when the shops want to get rid of these items to make space for the summer clothes. Conversely, I love to buy my summer clothing when there is 6 feet of snow outside. I know it is not normal to do that, and maybe that is why I like doing it. I love a bargain. I don't think I am alone in loving to buy cheap. As I said earlier, the world of trading is diametrically opposed to the world outside trading. The traits I display as a human being outside my world of trading don't serve me well in the world of trading. This is not just me I am talking about. This is people in general. Our minds struggle to separate the world of trading from the world of general consumer behavior. Let's look at the differences. Supermarket bargain. When I see something in the supermarket that is cheaper than it was before, or that gives me a discount for buying more than one item, I am attracted to buying it. My action is driven by a subconscious drive towards pleasure. My action is that of a rational consumer who will seek out the cheapest products. The supermarket knows this, and they will tailor their offering to maximize my spending. My behavior is driven towards maximizing my pleasure within my budget constraint. When I do so, it gives me a sensation of well-being. Financial market bargain. When I see the FTSE index falling in price during the day, my mind associates falling prices with value and becoming cheap. If I act on the impulse, one of two things will happen. 1. My feeling of value is confirmed. The market begins to rise. 2. My feeling of value is not confirmed. The market continues to fall. My argument is perhaps provocative, but no matter what happens next, I will end up losing, even if I win on the trade. If I buy with no good reason other than my mind sending me an impulse to say the market is cheap, I will lose if the market continues lower. And why would the market not continue lower? That is the premise of technical analysis. Trends persist. The market suffers from inertia, meaning that whatever it is doing now, the odds are above 50% it will continue to do. If I buy and the market